Good evening and welcome everyone to the Power of Passive Investing meetup. We're thrilled to have you guys with us today. We have an excellent presenter today, Tim Johansson. But before we give Tim the floor, let me do the usual spiel and go over a few of our admin notes. So this is the Power of Passive Investing meetup. As always, legal disclaimer, the presentation is only for educational and informational purposes. We're not selling anything, not offering any services. Please consult your own tax, accounting, and legal professional with everything. In terms of the housekeeping, feel free to type your questions in the chat box or in the Q&A. Tim will leave some time after his presentation for questions, and we're also recording this, so you'll get the recording as well as the Tim's slides that he already shared with me, and I'll be sending it to everyone along with the recording. So our presenter for tonight is Tim Johansson. He is enrolled agent, which is essentially a title that allows him to file tax returns and makes him qualified as a certified enrolled agent. He began his career in public accounting in 2005. He has over a decade of experience in public accounting, serving in a variety of roles and different clients and different industry, and consistently demonstrating a high commitment to service and technical excellence. In 2014, Tim began TRJ Accounting that focuses on providing professional and quality accounting services to fit his client needs. As Tim's practice grew, he found a passion for working with real estate investors. His own journey in real estate began in 2008 when Tim converted his primary residence into his first rental property. And after years of helping real estate professionals to achieve their goals, Tim created Real Estate Tax Pros in 2018. And today, Tim helps real estate investors in over 15 states to achieve their personal and professional goals. And as always, Matthew and I are the co-hosts of this meetup. Matthew is still somewhat in transit, but he's with us on this webinar. So if you ever want to reach us, if you have any questions to us, feel free to reach out. I have a couple of syndications for accredited investors. So if you folks are looking for depreciation or passive income, feel free to reach out, as there is still a few weeks left in 2022 to be able to take advantage of the investments this year and claim your depreciation this year as well, if interested. But without further ado, let me pass the floor to Tim and have him present. Tim, thrilled to have you with us.
Thank you so much. I'm going to share my screen now. Let's see. I prepared a presentation for you guys.
We can see it.
All right, perfect. Okay, great. So tonight it's all about how to offset active income with passive losses. I think it's a hot topic for a lot of my clients who invest in real estate. As they invest, they want to say, you know what, I have some net rental losses. How can I take advantage and decrease my tax liability? The key topics for tonight, we're going to discuss active versus passive income, passive activity loss rules for investors, offsetting active income with passive losses, and then Airbnbs, is it active or passive income? So to get started, active income, right? Everyone works, right? You get that salary earned, that W-2 income or services rendered through, self-employment income would be considered your active income. And then passive incomes where you're just sitting back, relaxing, collecting that rental dollars, et cetera. And that, dividend income, interest income is going to be your passive income. Generally, the IRS treats rental income as passive income. It's reported on Schedule 8 of your personal income tax return. And one of the benefits, it's not subject to self-employment tax. if you qualify as a real estate professional, which is you do more than 750 hours in the real estate profession, whether you work as a realtor, wholesaling, flipping, managing your portfolio, you meet that 750-hour requirement, you can treat your rental income as active income. And essentially all the clients I typically work with have net rental losses, which then would become active losses to offset their W-2 income. Passive activity loss rules for investors. So this is probably the number one question I get is, hey, I have a rental property, I report a loss each year, how am I able to take advantage? So the golden rule is basically if your adjusted gross income is below 150,000, the IRS allows you to deduct passive net rental losses up to 25,000 against your passive / earned income. But if you're greater than $150,000, unfortunately, that's the income limitation. And then those passive losses you're unable to deduct against earned income. And therefore, these losses, unless you fall below the $150,000 or were a real estate professional, would just get carried forward indefinitely until either you sell your interest in maybe the partnership or the property. And like I was saying, for real estate professionals, the net rental losses would be treated as active losses for which you could offset your W-2 income. Now I have a lot of clients, husband and wife, they're growing their real estate portfolio. And I ask right off, one of my first questions is, are we able to treat one of the spouses as a real estate professional? Maybe one of the spouses has a part-time job, or maybe one is, stay-at-home mom. Would they qualify? Would they be able to reach that 750 hours? If they have 3 or 4 rental properties that, they're doing maybe the BRRRR strategy, where they're rehabbing the property, finding the renters, refinancing those hours all spent in that time, searching for new properties would all qualify. And I have my clients basically keep track of their hours, maybe via an Excel spreadsheet, for which they would just track, they put the date, the description, and the time spent to track their hours throughout the year to see if they were to qualify. I have a lot of clients that are high earners, and if one spouse is able to stay home, maybe potentially they would qualify, where we can offset some of that high W-2 income with some net rental losses. Now the subject today was offsetting active income with passive losses. So converting passive losses and active losses with material participation for a real estate professional. So as long as you materially participate in your growing portfolio and have, you can basically qualify as a real estate professional, you'll be able to convert what would be passive net rental losses into active losses to offset your W-2 income. Now, I do have plenty of clients that invest in real estate syndications. And this is one of the questions. We have depreciation that comes through the real estate syndication, and they would like to know, hey, if I invest in a real estate syndication, am I able to take a deduction that flows through on their Schedule K-1? So the majority of the time, the answer is no, you cannot. And the reason being is that typically with these large real estate syndications, you're most likely going to own less than 10%. You're also going to not be able to materially participate. You're going to be checked off as being a limited partner. So right off there, having limited liability as a limited partner, regardless whether you're a real estate professional or not, the IRS is going to view this investment as being passive. Now, so there's going to be 2 buckets here, basically in your real estate syndication on a Schedule K-1. Box 1 is going to be your ordinary income or loss. Those losses in box 1, you'll be able to actually take a deduction for. However, box 2, which is your net rental losses, typically occur through depreciation. We will not be able to take a loss. However, there is basically it's very complex. But if you're a real estate professional and you elect to treat your real estate portfolio as being one activity, which would also include your investment in a real estate syndication, as long as you're doing basically 500 hours in managing your real estate portfolio. Not so it can't be other hours in, say, real estate coaching or flipping or wholesaling. It has to be 500 hours just specifically related to the rental properties that you hold, whether it's through, a partnership, or it's also through maybe scheduling of your personal tax return showing as a personal investment. If you're doing those 500 hours, then potentially you could treat those syndication lawsuits that are in box 2 as being active. But again, that's very complex and it's unique. So everyone's situation is a little bit different. So I can't, this is just not a general statement for all. So I'd have to really look at your unique situation to see if you potentially could qualify for having these syndication losses deduct against your W-2 income. And then lastly, Airbnb, active versus passive. So over the last few years, Airbnbs have been very, very popular. Everyone's loving that short-term rental model. Typically, the IRS looks as rental income as being passive, for which it's being reported on Schedule E. Typically, what I have is I have clients that I'm engaged with when they're getting started in real estate investing. I have them set up basically 2 LLCs. I have one LLC for which I would refer to as like a holding LLC, for which they would purchase a property. And then the second LLC would be what I would like to call it as their operating LLC. And the benefit of having this 2 LLC structure is we're able to actually remove the rental income off of your personal income tax return on Schedule E and report it on a partnership tax return, for which is not as scrutinized with the IRS. So it's kind of 2 benefits. One is I feel that lenders view what would be a personal investment on Schedule E, reporting on a partnership tax return looks like it's a real estate investing business, and lenders tend to give you more favorable rates, maybe a little higher loan to value. And then the second case is where a lot of husband and wives, they can either elect to one, report the rentals as being personal on Schedule A in their personal tax return, or elect to file as a partnership, and this benefit would come into play as far as being a real estate professional. So I always love to have that structure with clients. Airbnbs are a little tricky now because typically investors now are a little bit more active when it comes to Airbnb. So the IRS had stated a couple of years ago that if you materially participate and the average stay of your renters is 7 days or less, it's actually be reported on Schedule C of your tax return. The benefit of doing so is that the income limitation that we had previously discussed in regards to, if your adjusted gross income is above 150,000, you can't deduct any of these passive losses. Well, now if you report your rental or Airbnb rental income on Schedule C with depreciation create a loss, you're going to be able to deduct those losses against W-2 income, / earned income, because it's now on a Schedule C. Now there's potentially Airbnb income to be subject to self-employment tax. One, it'd have to be profitable, but 2, just like hotels, they're basically, if you're treating your Airbnb as, like I said, hotel, and you're providing substantial services as turn down service, linens, cleaning services every day for the stay, providing, maybe travel, from to and from the airport, etc., to your guest, that's considered almost like you're a hotel, and therefore you would be subject to self-employment tax. But also, whereas if you have an Airbnb and you're kind of really hands-off and kind of, you just have it set up on Airbnb's website, and you already have a cleaner that you're hiring that comes in and stuff, and you really don't have to do much, then you can still treat Airbnb as being passive. So I think that's it for today, and I wanted to share my contact information. If anybody would love to reach out, I'd be happy to help. My website is retaxpros.com. Here's my cell phone. Feel free to text or call. And here's my email, tim@retaxpros.com.
Tim, this was awesome. Thank you so much.
Oh, you're welcome.
Folks, feel free to type your questions in the chat or in the Q&A, and I'll read them. Or if you want to speak, just raise your hand and I'll unmute you. In the meantime, Tim, I wanted you to run through a couple of scenarios. So if you could just go to the previous slide, I want to ask a few questions about that. So second bullet talks about treating rental income as active and subtracting it against ordinary income. So can you clarify the material participation here, please? Is this the same as for real estate professional, or is this different?
This is different. So there's no, minimum 750 hours. It's just that you have to participate. Meaning that if, you're going on Airbnb.com and, you're getting feedback as people are leaving you reviews, you're scheduling the cleaner, those type of things, you would then qualify. So there's no 750 hours because the turnover is so much. It's not like you have a long-term where somebody's booking for 6 weeks or the entire year with long-term rentals. So therefore, because you have to be more hands-on with so much turnover, being short-term rentals, that the IRS says, you know what, you can treat this as being a Schedule C.
Amazing. So even if someone has one rental, regardless whether it's a house or a condo, and the tenants stay less than 7 days, and this owner is doing all of the Airbnb and set up everything themselves for this rental, then it's treated as active income and goes on Schedule C?
That's right. Exactly.
Wow, that's huge. I mean, especially for the folks in higher tax brackets, I think this is a big win where, the material participation for regular real estate professional status for long-term rentals is so much more complex and involved, and you practically cannot do it if you have a W-2 job.
Well, that's right. So I have a lot of clients who are high earners, and that was one of the biggest complaints is, hey, we're investing in real estate and we can't take advantage of these losses. So one of the things I've done basically since 2008 was, this two-structure model of having 2 LLCs, and on a real estate partnership tax return, we're able to take what would be like general operating expenses related to the properties or as the partnership as a whole, and deduct them as ordinary business expenses. So therefore, those basically expenses or loss would get reported on box 1 of the K1, ordinary loss. So these high W-2 earners were able to take some losses of what would be, property expenses. Whereas, I have clients that say, I want to take a deduction for, my expenses related to searching for other properties. So what happens is they want to take these deductions. They maybe didn't find a property. They're going to deduct it against properties that are already kind of stabilized and rented out. And then when they're taking these other deductions against those properties, they look like they're underperforming. So when they go to refinance, and even after the lender adds back depreciation, they're still at a net rental loss. So, and then it's harder for them to explain, oh, well, it has to do with, my search for my property, let's say. So when we report this on a partnership tax return and kind of have these deductions as general operating expenses to the partnership and not direct expenses to the property themselves on what would be Form 8825, your properties look like they're performing well, and then you could still have a general operating loss, which then these W-2 earners that maybe husband and wife both work, neither of them qualify as a real estate professional, but they're able to take some type of deduction, whether it may be continuing education or paying for, a real estate coach like yourself, participate in the classes and want to take a deduction for that. And I'm always saying, no, you don't want to deduct those kind of expenses against your properties. Better off having it on a separate tax return where you're able to kind of take advantage of those things.
Got it. Okay, I don't see any questions from the audience so far, so I'll keep on going until I see some questions from folks, and then we'll stop. So another use case, so the person has this one Airbnb rental W-2 job, and let's say on top of it they have one long-term rental. They're renting a single family house. So is the case such that the Airbnb expenses will be subtracted against their ordinary income, but the long-term rental will stay as passive?
That's right. So I just dropped up someone's tax return where they had 2 rental properties on Schedule E, and then they also had a few Airbnb properties, and we reported on Schedule C. They did not make the election to treat all of their properties as being one. If that was the case, then no, everything would get reported on Schedule E.
Got it. Excellent. And it looks more like a compliment than a question from Evangeline, so I'm going to read it. I love the fact that you're suggesting valuable advice to help with tax questions. I visited a few accountants, and all I hear is the taxes are the taxes. We wanted advice on whether investing now would help us, and I guess, I don't know, didn't get it. Evangeline, let me know if you wanted to ask a question, but thank you for the compliments.
Yeah, thank you so much.
Tim, if you want to switch back to your contact, by all means, go ahead.
Sure.
Feel free to do that. So then well, before we go into use case, perhaps it makes sense to talk about what is that rule called where you're combining everything into one, but it's not black and white. Help me, what's that called? Where you're treating everything as one for the purposes of real estate professional.
Yeah, you're making the election.
Election, thank you. Yes.
Yeah, so you make this election, right? So what happens is, let's just say I have 3 properties, right? And I want to qualify as a real estate professional, or at least make that argument. What happens is the IRS will actually treat every single one of your properties as being separately. So they would say, hey, you know what, you have to have 750 hours on this property or this property or that property, right? Not as a whole. So generally we make the election is treating all of my properties as one, so that it's one activity, and therefore all of your hours combined, they're not just viewing it, each activity separately or each property separately.
And what are the pros and cons to that? Because it has both.
What are the pros and cons?
Yeah.
I mean, we were just discussing the Airbnb, right? And I think that's the only thing I really come to as far as a con is if, hey, we make the election, and the election has to be made every year, mind you, right? So if you make the election one year, you'd have to make it again the next year. So all of a sudden you go from holding long-term rentals, now you switch to an Airbnb model, we'd have to make that election again. So essentially, you want to keep that Airbnb separate, especially if you're not going to qualify as a real estate professional and you want to have those Airbnbs listed on Schedule C. Mm-hmm. Now, this is all new with the IRS as far allowing, schedule or basically Airbnb, which is essentially going to be a net rental loss on Schedule C. And it's always been is that if, you're self-employed, right, you're filing a Schedule C and you report 3 years of consecutive losses, right, the IRS could deem that this business that you have as being a hobby. Well, what are they going to do now when typically, Schedule C is not rentals, right? It's now an Airbnb for which, with depreciation, you're going to have a net rental loss or net Schedule C loss after 3 years. Is that going to be, question to the IRS? Or are they going to say, hey, really Airbnb is now a hobby? I mean, I don't know what they're going to do, or maybe it's just with the business code, they'll search and say, hey, you know what, this is for an Airbnb, you don't have to worry about it. But that's something we haven't crossed yet, but it's definitely right now, it's a loophole as far as someone that does not qualify for a real estate professional. They are in the business of doing Airbnbs, because the argument would be like, you know what, I am actively involved in an Airbnb, and it would be really hard for the IRS to say that you were not active, because everything can be done remotely, right?
Yep.
Now, right? Just look all the, we're on Zoom today, right? So just, it's a crazy world now.
It is absolutely agree. Okay, I'll keep going with more cases. I still don't see any questions. So another case. So a couple W-2 professionals, they invested in a syndication. They're actually invested in a bunch of syndications. One is selling, the other one they invested offers them loss through depreciation and cost segregation study. Can they offset that loss from depreciation against the gain that they're getting through another syndication that's selling in the same year.
So their entire investments all through syndications.
Yeah, they have a bunch, let's say, 4 or 5, whatever.
And you're saying
But
one of the
only two-
syndications, so one of the syndications has a loss, the other one has, whether it's a long-term capital gain, the other one has a short-term.
Correct, long-term capital gain. I'm sorry, that's good to clarify. And the other one has a loss because they just invested, and through the cost segregation study, they will be getting a loss. Can one be offset against the other? The passive loss from one syndication offset the long-term capital gain from another syndication?
No, so they're two separate buckets as far as, hey, one's a long-term capital gain. The other one's going to be in box 2, which we're discussing on schedule K1, which is it's going to be a net rental loss due to that cost segregation and the higher depreciation number. So therefore, you're going to have this large net rental loss potentially on box 2. But because you're a limited partner, not a real estate professional as well, therefore, you're not going to be able to take advantage of that larger number. And you're going to still be subject to capital gains tax on the K1 that's reporting that capital gain.
Okay, so if this loss is allowed to be carried forward, correct?
That's exactly right. So then, say let's say year 2, now, one of the K1s has a net rental income and the other one has a loss. Those two could offset each other.
This loss that's carried forward, it's going to be an operating loss. What you're saying, it's not a capital loss, it's an operating loss. Is that what you're saying?
I'm saying, so if you have, you have 2 real estate syndications, right? You have one K1 that has net rental income in box 2, and then you have another syndication that has, a net rental loss in box 2. Passive losses are going to offset passive income.
Okay.
Okay, so and let's say, for example, you had a net rental, income on the schedule K1, the first, it was $12,000 profit. And then you have a loss on the syndication for $10,000, right? Those would net to $2,000. But then you could potentially have passive activity loss carryover from prior years that would basically offset the other $2,000. If I, invested in syndications, there were always losses each year.
Got it. Okay. That's helpful. Thank you. And we got a new scenario from the audience from InvestUp. Thank you for providing it. So let me read it to you. Scenario: multiple properties on Schedule E produce rental losses that cannot be deducted due to being passive. So they get carried over for multiple years until a quite large loss is accumulated. When you sell one of these properties, can you offset capital gain with these carryover passive Schedule E losses combined? Or do you need to keep track of losses for each Schedule E individual property, and only the sold property accumulated losses can be used?
Okay, great. That's a great question. So the gain, so I sell a property, right, that I've been basically, renting out for years, accumulates a large passive loss carryover, right? Maybe I have 3 or 4 other properties as well. I sell that property, I'm going to have a long-term capital gain. I'm also going to have some depreciation recapture. All right, so that's going to be on Schedule D of your tax return. Now, what happens is, because you sold that property on Schedule E, all those passive losses that have been carried forward every single year, you now can exhaust all of that year. So now you're going to have this big loss, which we're actually able to deduct against earned income. So basically, those losses for that one particular property, right, that you sold, now actually you can deduct against W-2 income. So those losses now become basically active losses.
Active income and capital gain and the recapture
It's not
amount?
going to offset your capital gain, right? That's a different bucket. It's going to offset actually earned income.
Only earned income. Got it. Okay.
Right, because the long-term capital gains, it's going to be capped at 20%, right? Depreciation recapture capped at 25%. So you're going to have, and then ordinary income level, you might be at a much higher rate.
So essentially, to the question from InvestUp, you can only take the losses from that particular property, you cannot combine them together, right? You need to track them separately.
Yes, so that your accountant should be doing that on Schedule A, right? So they're going to flow through to your passive activity loss schedule. And then on there, it's broken down per property.
Got it. For the gains from the sale of your property and the recapture amount, are there any deductions? Is there anything that can offset those two or one of them?
No, not really, right? I mean, I would just say try to minimize your capital gain. So, I have a lot of clients who are like in the BRRRR strategy. So we're like, hey, you know what? We're already working on one project. We're selling another. Maybe we can remove some of the, or allocate some of my cost basis that's in one property to this property to kind of reduce my capital gain.
So can you go a little further into allocating your capital? Are you talking about 1031 exchange or are you talking about something else?
No, I'm talking about something else. I'm talking about, I have a lot of clients that deal with the BRRRR strategy, right? So they're buying and they're rehabbing, right? So maybe they can take some of their rehab costs, right? And other things they're doing in say property A, and now they sell property B, they may be able to allocate some of their expenses they've had on property A to property B to kind of reduce their capital gain, as long as it's not excessive.
Sure.
But you don't want to do where it's like it's substantial. It's like, hey, the IRS is not going to believe you only made $20,000 of profit on this one property that you've held for 4 or 5 years.
Got it. Got it. Okay. Thank you.
You're welcome.
I don't see any more questions. Let's run through a few more scenarios. And Tim, feel free to suggest some.
If you had other investments, right, that you would want to sell, right, the stock market's way down. So I'm just talking with clients now that, hey, I sold a property in August. Is there any way I can offset some of that? So one of the things we're discussing is, hey, let's compute what your capital gain is on the sale of that property. But also, is there any other investment that you may have? If you held Apple stock, let's say, you could sell that at a loss and then offset. Remember, because it's Schedule D, you're able to offset some capital losses against some of the capital income.
Got it. Yeah, no, that's a great strategy.
Or gain, I should say, not income, but capital gain. Yeah.
Yep. Yeah. So both are capital gains and losses, so they qualify to offset one another.
Exactly. Yep.
Yeah. Here's another one that you've probably seen. Let's say someone has a traditional IRA and they decided to convert some of that into Roth. Again, talking about stock market, the investment lost value. You still have the shares of your stock or fund, but the value is lost. So you're converting it at a lower value, but you will be responsible for the tax on that conversion. Is there anything that can help you offset that tax?
So you're saying you basically you put money into a traditional IRA for which you were taking a deduction each year. That you're making, there's a non-deductible piece of that. So I work with a lot of investors or a lot of high earners, right, that are basically making non-deductible contributions. So when they do a backdoor Roth IRA contribution, it's basically it's post-tax. So they're not, they're not actually having to pay any tax. But somebody that's been taking that deduction each year, $5,000 or $6,000 deduction. No, there's no way really, right, that you're gonna be able to offset that. You're gonna get, a 1099-R saying, hey, you know what, you distributed this money, right? That was your basis of the money, you took a deduction for it already. So therefore, you have to pick it up when you make the conversion.
Right. Yeah. Yeah. I mean, some people are taking advantage of the stock market fluctuations, turbulence really this year, and converting it at a lower value. So they would be still hit with the taxes, but it's probably going to be a lower amount because of the converted value being lower at the
Well, that's right. They're just going to remove, if I put, $60,000 and now it's worth 45, right? I'm going to move 45, over. The thing is, I'm moving 15,000 less, right? So therefore, I shouldn't be taxed on the entire 45 because I just sold it at a $15,000 loss.
Yep. Even though you're converting the full shares, the shares are there.
Exactly. Yep.
Got it. So there's nothing to offset this type of tax, essentially. That's what you're saying.
Yeah, I'm gonna try to think of other avenues that you're like, hey, is there any other losses or something like that that we can kind of, help to reduce that.
Okay. Okay, let's go to another scenario. And thank you so much for running through this scenario. I'm sure that's going to be very helpful. We shared with a lot of folks on our list that are both active and passive investors, and I think these are definitely applicable to a lot of people. So
Right, I love this. I mean, every day I speak to investors, right? So it's like everyone's situation is unique. I do get a lot of the same questions, but then there's also questions I'm like, oh, I've never heard before. And I'm learning every single day new things. So I think it's great.
So Tim, what differentiates you from many other accountants is you are a real estate investor yourself. So you're speaking from personal experience where when folks are reaching out to the CPAs, they might be dealing with investors, but when they're not investing themselves, they can't relate to that experience. They don't have their own hands-on experience, and that's what makes you stand out, essentially.
Well, that's true. But I've also, when I first started my practice TRJ accounting before I got into the real estate stuff, was I was learning just every day through my clients. If somebody was doing like, kitchen cabinet building, I was learning all the costs that went into the cabinetry and stuff, and I was learning somebody that was like a roofer or a dentist, right? Always taking a little something out of it. A couple of years ago, I picked up somebody, that was doing hard money. And I learned a tremendous amount about hard money and how to account for it and stuff like that. You know what I mean? So it's just, every year I'm learning more and more about real estate and just small business in general.
Sure. So another scenario, again, W-2 professionals, husband and wife, invested in a few syndications in the past. New year, one of them is no longer W-2 professional. They went into real estate, started buying their own properties, and became qualified to be real estate professionals because now that's all one of the
They focus on, yep.
Yeah, buying it. What happens to their income from their prior syndications? Can this offset the rental income or whatever the person is doing now?
I mean, I guess the first question is, now that they're a real estate professional going forward, can these syndication losses be treated as being, active losses? So that's a big if. So I think the first thing you need to focus on is, hey, how did they invest through this syndication? Is it in the husband's name? Is it in the wife's name? Is it an LLC that they both jointly own? I see that a lot. So it's like, oh, you know what? We can, if it's held through an LLC, we can easily modify the operating agreement for the LLC to say that, the spouse that's a real estate professional owns a larger amount, right? And then the question is going to be, hey, are these, is the syndication losses going to be treated as active? So my first question is going to be, regardless of real estate professional status, right? We know we qualify for that, but the IRS looks at, hey, this is a limited partner investment, therefore it's considered to be a passive investment, right? But if they have a substantial real estate portfolio rentals, are they spending 500 hours or more in that real estate? Two, if they make the election to treat all of their syndication and their rentals as one, they're doing 500 hours in just the real estate portfolio, managing their rental properties, then yes, that real estate syndication would qualify, right? Now, the question is, hey, would it trigger the basically the back stuff? And that's not the case. You're not going to be able to say, hey, you know what, all these losses that were passive, all of a sudden they're not going to be treated as being non-passive or active.
Got it. Excellent. Thank you so much. Yeah, no, that sounds amazing. Good scenarios. I don't see any more scenarios. I don't see any more questions from the folks, but I personally think that this was very, very helpful. Folks, Tim's information is in front of you, so feel free to reach out. I would say now is a great time to reach out because starting January 1st, Tim, just like other real estate tax professionals, will be preparing for the next busy season, and it will be a lot harder to reach probably.
Yeah, fun times, right?
Fun time, yeah, exactly.
Yeah, 1099s, partnerships, S corporations, then personal taxes. So
sure.
on 4 months of the year in the beginning of the year.
Yep, and that basically never ends, even though the supposedly 10/15 is the last deadline, but it probably continues beyond that.
Well, no, and then I go right into year-end tax planning, and that's what I'm kind of doing now. I'm like, when does this stuff ever stop? And then throughout the year, I constantly, are forming LLCs for my clients as well. And I'm, doing like daily Zoom meetings as well with my clients and stuff, just talking strategy for year end here.
Excellent. Tim, this was very, very helpful. Again, thank you so much,
Oh,
folks.
you're welcome.
The recording will be shared with everyone in the next day or two. Please feel free to reach out to Tim and take advantage of his knowledge of real estate. Thank you and have a good night, everyone.
All right. Thanks, everyone. Bye.
Bye, Tim.